So you guys are in for a treat. I'm going to kick this over to Garett. Garett's gone through the whirlwind of preparation to make sure that this is a very content-driven, focused mergers and acquisitions panel. So thank you so much. I'll let you take over.
Is this working? Okay. Well, I think it's been a great opportunity to be here. Thanks for inviting us to do this panel with you guys today. And I hope we can kind of live up to expectations following two already really great speakers who honestly have a lot of really valuable and important things to say about the wonderful world of mergers and acquisitions. I was talking with Nathan a couple of months ago, getting ready for this one, and he's like, well, what do you want to do? And, I've spent my career working in finance and mergers and acquisitions in the whole nine yards, and I'm like, we talk about valuations and exit strategies and financial engineering and all of these sophisticated things. And at the end of the day, that's kind of the price you pay to sit at the table. The real hard work in acquisition, what it means, what it's going to do for you, literally happens after that. Despite the best strategies and the best planning and the best everything you do, things happen, and you run into challenges along the way. And we talk about discipline and rigor and the ability to pivot and so on as being really, really important parts of sort of succeeding in the mergers and acquisitions world. Like, how quickly can you identify the problem? How can you come together and pivot your strategy and adjust, and then ultimately create that value that Ajay was talking so eloquently about. And there's a lot to this, and it can be very hard to do. And so the thought today was to get together a few panelists who have some good experiences around M&A to kind of share what their experiences have been on that journey, what kinds of challenges that they've had to deal with, because they can hit you of all kinds: supply chain issues, organizational structure issues, data and IT integration issues, or a host of other things. And so the thought was to get these gentlemen together to share some experiences, to talk with each other in a discussion sort of a way about how to kind of navigate these issues, and then allow you guys to kind of talk and join in the discussion as well. So by way of introduction, we have Earl Foote, who is a lot of you probably know, the most prolific bassist on the panel here, who has been doing some really great things with Nexus IT and kind of some of their recent experiences and acquisitions. And then we have Adam Campbell here, who comes from done some senior housing work in the past, similar to some of the stuff that I've done, but nowadays works with a lot of PE groups and sort of sponsored equity groups to act as their CFO and create their investment strategies and execute on those. And then lastly, we have the amazing octogenarian in the group, Bill Kirth, who never ceases to amaze me on what he's been involved with and been able to accomplish through his career of largely corporate finance and investment strategies and angel investing, and just kind of watching some of these early stage companies really kind of get off the ground and soar. So, with that said, I hope we can have a real good discussion today, and hopefully, give you guys some great ideas about what the buy-side post-acquisition life of an M&A actually looks like, and how to kind of jump through that. So first, I wanted to turn the time over then to Adam to maybe share a few words about some of his experiences and stories and in his challenges.
Yeah, well, it's great to catch all you guys and be able to share some stories and experiences. So as Garett talked about, a lot of my background's been with private equity groups. I worked for a long stint with family offices. So I did a lot of wholly owned companies on the buy side, the sell side. I worked a lot of joint ventures, a lot of partnerships, a lot of independently sponsored deals. So I've seen everything, all sorts of across different industries on the buy side and the sell side. And luckily was able to work with some great partners and great executive teams to work through things. But at the end of the day, there's always a point when you're doing the buy side and you're working with different groups. Have any of you guys had deal fatigue getting through a buy side, sell side transaction? Anybody out there? Yeah, it's like anybody who's gone through that, seen kind of the getting through it and being like, they're going to make one more request, they're going to dig in one more accounts receivable number, they're going to make one more basis point valuation adjustment. And at some point on the buy side, crap hits the fan, and you're just looking at it going, if these guys don't freaking close tomorrow, I'm done. I'm out. And there's so many times I've seen it, and the best indicator is always the spouses looking at it going, okay, how does your wife think the transaction's going? And you ask your wife, you're like, am I still sane? They're like, no, you're not. It's gone too far. And so I've seen a lot of those kind of transactions go to that point, but I've seen some phenomenally well-structured transactions where the numbers work, the market's there, the indicators there, the quality of earnings report comes out clean, the management team's prepped, the owner comes into the organization and all the groundwork's laid perfectly. And those days were so nice where you come and you tell the employee base, hey, we've got a new ownership group, we've got the new majority owner, and we're gonna meet him 2 days later at the Friday all hands meeting, and you get the new owner in there, and they're standing in front of everybody, and they're just salivating. What's the plan? Where are we going? This has been a phenomenal ride. We're super excited to have this in here. The prior founders have talked you guys up so much. We're stoked. Like, come give us the wisdom. And from one side of the transactions being exhausted and barely getting across the finish line to the other side, where the team's just stoked and ready to add value to it. There's been a lot of experiences that we've had across the line from the private equity side and the family office side, and now on sponsorship doing a lot of JV side. So I'm stoked to be able to share a lot of experiences and some info, and we got a lot of powerhouse guys to be able to talk to you as well. So,
when you and I were talking a month or so ago, kind of getting ready for this, we had discussed, like, you sit down, and regardless if it's like a perfectly executed plan or a much more challenging one along the way, you run into the road bumps and the hurdles, and it can come from all tiers in the organization. And I'd love to hear you maybe share some of the points you had about that story with us, about kind of dealing with the troublesome board and some of the challenges you ran into there.
Well, there's two sides that it really comes back to on that, and one of them I'd say is, what kind of a capital partner is it you're working with on the buy side? Like, are they adding smart money to the group, or are they adding dumb money? And that's kind of what I've looked at. Everybody's going to add good value. They're going to try to get in there. But is it in a way that's opposite from what the team has, and they look at it and go, you guys have been running an ABC plan for the last 20 years, and you've been successful at it. And now we're just going to reboot everything, and we're going to go plan 1, 2, 3. And I've seen some times where it's like, it wasn't that the guys weren't willing to work hard, but the capital that came in was stupid capital. You looked at it and said, the plan won't work. You acquired a team that doesn't have synergies. You looked at it and said, you've got a great operations manager. You want to put in this role to create some synergies, and you didn't realize that their operations manager was the key of their success. And you're just going to blow this thing up. And sometimes, just being in a vacuum, sometimes there's a little bit of a Chinese wall between the sell side and the buy side. You guys have probably seen, how many times do the employees have any idea what's going on? Do they have an emotional availability of, like, can they get inside? Can the VPs really see full transparency? Or is it just this iron curtain? Sometimes that capital coming in, as hardworking and as well-intentioned as they have, it's just dumb money. And the other side of it's just looking at it saying, how emotionally ready is the team stepping in, and how emotionally ready is the team to step out? Is it a surprise? Are they ready? Are they exhausted? Sometimes the team that's leaving, they've got a stay around bonus, but they just cashed out on $400,000, and they're supposed to be working day one in a new plan and a new team, and you're not expecting that they're going to go take a trip to Italy to blow a couple $100,000 because they made $1 million? Like, are you emotionally ready to jump back in the saddle after making good money, or after having your entire team disrupted? It could be really, really hard. So looking at it saying, is it smart money coming into it, or is it really dumb money coming into the organization? That's a big one. And then, is the team emotionally ready from the buy side and from the sell side to re-engage in your next market plan? If you've got those things lined up, you got a pretty good chance of success. But those aren't things that show up in your quality of earnings report. They're not something that you're going to get on just a high-level management review. You're not going to be able to just parachute in and be like, okay, everybody's emotionally ready to get this thing working. It takes a little bit more finesse. It takes a little bit more questions. It takes, honestly, a few more nights, late night, till 1 a.m, sitting having drinks, wait until everybody's just a little bit more relaxed. Here in Utah, it might not be a bar, but an Applebee's, sitting some ginger beers.
Ice cream bar.
Ice cream bar, yeah. Late night ice cream bar. Just having those sincere discussions, figuring out you're going to make $500,000 in this transaction as a VP. Are you ready to jump in day one? Is your wife willing to support you on a couple late nights after making a good cash out? Or are you emotionally gone? Or as the new owner coming in, how do you handle those things? It's a big deal.
So those kinds of issues can end up causing sort of significant gridlock in the decision-making process post-merger. You run into challenges and integration issues and whatnot. What have you seen as maybe some of the best ways to kind of cope with that sort of organizational gridlock that can arise?
I'd probably say I've seen a lot of different things. One of them is very sincere, honest conversations of how money changes the organization. If it comes down to anything, it's if an owner comes in and there's no money, that changes something. If the prior owners get a lot of money, that changes a lot of things. There's some people that you write $1 million check and hand it to them, it's going to screw up their life. It does. It happens. It's weird because most people don't know, what do I buy 2 Ferraris? Like, what the heck am I going to do with all this? It really makes you question, why am I going to work? So that's one of the biggest metrics that I've looked at is how is money going to change the organization? Do you have working capital that you're bringing in so you're going to grow it with money? Are you trading out capital? Are you cashing out people? That's one of the bigger ones, but I'll be honest, Earl's the man for this question because he's done this over and over and over again. Yeah. Yeah, but I'd probably look at that and say, as an owner buying in on the buy side of the transaction, if you have capital reserves, if you're just buying out partners, and when you're cashing out the existing team, how does that money flow for them? What's the impact both in the organization and to the individuals personally? And having those conversations very early on in the organization. And it's weird to go somebody and say, I'm going to buy, we're agreed, I'm going to buy your group for $10 million. You can literally ask them and sit down over ice cream, say, you're just going to cash out. Your piece of this is like $2 million. I know that. I know the cap table. What are you going to do with that? Are you going to come to work? Are you going to buy your Ferrari? Are you going to be in Italy for a couple of months? What are you going to do? And just walk through that and see where they're at emotionally to be able to prepare for that transaction event so you don't have to guess what's going to happen after you close.
Yeah, and thank you for kind of sharing that perspective on that. I think as we get into and talk a little bit more, it's always fascinating to me just to see how the direction of the ultimate merger and integration is going to be set by the top and the leaders in the organization. You can never underestimate what happens when you get a little bit of gridlock there and how that's going to impact your ability to progress and move through things. So that said, I do want to give some time to Earl for our next kind of commentary on some of this, who recently went through a pretty large acquisition late last year, and it's been the subject of some really interesting organizational design pivots and so on. And so I'll let you share a little bit about that.
Sure. Thanks, Garett. How y'all doing? Good. Just so I know kind of the audience we're talking to, how many of you in here are M&A professionals? And how many of you in here have been part of an M&A transaction, either buy side or sell side? Okay. All right. So let me maybe give you a quick overview of our story, and we can talk a little bit about some of the our key learnings that we've picked up along the way. So Nexus IT, by the way, is an outsourced IT and cybersecurity firm, or what is known as managed services, managed security services. We've done 7 total M&A transactions over the past decade between different founders in the team. Garett is our fractional CFO, and we've relied heavily upon his M&A experience, as well as our chief people officer, his M&A experience with organizations like HP and Kodak. So we did several smaller practice M&A transactions, and last year we did a much larger one. We're going on almost a year. That organization that we did we call it a merger acquisition with, and we call it a merger acquisition because those 2 owners of that entity I brought into the cap table of Nexus IT. I gave them equity on our cap table, so it was a partial cash, partial share swap transaction. And in the process, I brought in 2 new partners and C-level executives into the organization. Strategically, I did that on purpose. We had grown to a point As CEO, I had 15 direct reports, and we were growing fast, and I needed more founder, C-level executive muscle in the organization and work ethic, to be able to continue the growth where we were at. And so we intentionally sought out, an organization and some leaders that we, wanted to bring in to help us continue to the next level of the organization, continue our organic growth strategies, but also our strategic growth strategies in our M&A practice. For me, some of the most important things to think about in an M&A process, and Peter, you talked about this. Thank you very much, by the way. Very inspirational story. Peter talked about prospection, if I got the word right. I'd never heard the word before. Real quick, how many of you in here run businesses? Most of you. How many of you know the term post-mortem or practice them in your organization? Okay. Have any of you ever heard the term pre-mortem? Pre-mortem. Okay, all right, Wade. Pre-mortem, in my opinion, is prospection. So this is a practice, and by the way, the best organizations in the world get really good at pre-mortems and post-mortems. We call post-mortems retrospectives. It's a little bit more friendly, doesn't have quite the negative psychological connotation, on teams. It's not quite as psychologically damaging when you call it a post-mortem, right? Anyways, but we do a lot of pre-mortems, and pre-mortem, in my opinion, should be part of the M&A process. Ajay talked about really analyzing, what are the strategic benefits of bringing together two organizations, and how are you going to make 1 + 1 = 3 or more? In M&A, that's called accretive benefits. How do you bring together strengths, capabilities, client books, operational efficiencies, economies of scale, so that you make 1 + 1 = 3 or more? And in that process, it is my recommendation that you go through pre-mortems. You think about you think about the future, what you're trying to create, and what could go wrong, because things are going to go wrong. Just have that in the back of your mind. That's business, right? Those of you who operate businesses here, who've run businesses, that very rarely do things go perfectly according to plan. You're always going to have some sort of bump in the road that comes along the way that you have to figure out and deal with. In my opinion, I'll tell you where I think those biggest bumps come from in the M&A process. When you do M&A, you have several different ways that you can acquire and then integrate or hold a company. Many organizations, for example, we all see LHM, Larry H. Miller Organization, doing acquisitions. Steve Stark leading that. Steve and his team, their strategy is we acquire and we don't do any integration work for 12 to 18 months. We spend 12 to 18 months building relationships, and then we start slowly and methodically our integration process. Why? Because what I'm going to tell you is the most challenging part of M&A, and where things can really go wrong, are the human dynamics, the relationship dynamics. The best performing organizations in the world understand and know that high performing cultures are based upon psychological safety and trust among teams. And when that does not exist, you will not produce the outcomes that you intend. And that is the exact same scenario in M&A. You talked about the emotional readiness of teams and leaders on both sides, Adam. And if they're not ready to engage, if they don't see the vision and purpose, and they don't want to go create that future together, you're going to run into some problems. The other integration pieces, like I'll be done here in 1 second. The other integration pieces like finance, tech, billing, HR, payroll, benefits. You're going to run into some challenges in all that kind of stuff, but really those are pretty easy and quick to get through. Usually it's a few days, it's a few weeks where you have to work with some vendors or software providers and stuff like that to work through those problems. Have your teams work through them. Where you're going to have the greatest disruption is in that cultural integration piece of humans coming together, right? Particularly if you're reorganizing and shuffling leadership positions and organizational structure within the within your company. Garett mentioned it, but I think some of the most helpful behaviors when it comes to doing an actual, executing an M&A integration and getting the accretive benefits, is to have the discipline to learn, have the discipline to document your learnings in your M&A playbook, and then have the discipline as leaders to make challenging decisions and execute those, and to pivot and iterate as many times as you need to until you start to get it right. It's very likely, again, that during the process, some things are going to go wrong, and you're going to get blindsided by things that you did not expect to come along, and you have to be very disciplined at staying grounded, keeping your emotions out of it. Being emotionally intelligent in the process, taking a 30,000-foot view of the situations, doing root cause analysis, and then coming up with ideas of how you solve the problems and experiment, iterate. Little by little, you start getting some traction, and you realize, okay, that's working. We're gonna invest more time and energy into that, right? Anyways, that's kind of my story and my off-the-cuff learnings that I think are important as you go through the process.
Yeah, thanks for sharing that. And the thoughts going through my head as you're kind of sharing some of these learnings from this last year on this rather large acquisition, where essentially you close to doubled your staff in size as we kind of put this one together. Your ability to kind of successfully navigate an integration comes from your ability to identify the issue and pivot. And that can sometimes be pretty easy to do if it's sort of number or financial or some other metric driven. But how do you identify that when it's a people issue?
Yeah, very, very good. So actually, we do that through anonymous feedback. Our chief people officer, who he's done a bunch of M&A for large enterprises. He's been a CEO, startup CEO, mid-sized CEO, and different things. We use a product that he built actually called Xmetrics. It allows us to anonymously pull our team and get feedback on where things are at. We gather sentiment. If you have real high trust on a team, people are going to give their feedback, directly to you. And we try to encourage that sort of environment that's an open door environment of, hey, if you have a concern, come talk to your most immediate supervisor, a leader, an executive on the team. We manage engineers. Engineers are not notoriously open, about their feelings. And so, through giving them an anonymous mechanism, and in fact, this morning I got one of those surveys in my email inbox from our service desk team, and we identified a concern there. We give our team a forum to be able to give constructive feedback, to share what they feel is going right and what they feel is going wrong. And we identify gaps in their experience versus their expectations. And then we have to sit down as leadership teams. So, we have weekly syncs, we have monthly leadership meetings where we review that data, and we gather more information from those mid-level managers that manage those individual contributors. What do you think's going on? why is this happening? Help us interpret the perspective, help us understand it better. And as a team, we do that root cause analysis. We try to pinpoint, what's happening. Is it a specific leader, that leader's behavior, the way that leader's treating somebody, or is it somebody else on the team, or is it an executive and that executive's behavior? By the way, I'll give you a quick hack. Culture in an organization is executive team behavior at scale throughout the entire organization. So when you have dysfunction in a given team, it's likely that trickles up the organizational chart into a manager or the C-level executive. And so you can pinpoint it. I think we get pretty good. Of course, we have a shortcut because Jeb, our CPO, is on our team, and this is what he does. He actually has a doctorate in the neuroscience behind high-performing teams, and so he's able to help us identify pretty quick. I think this is what's going on, and then we come up with solutions and ideas, and we go to work on fixing those. Now, we're dealing with human emotion. It's unpredictable, right? It can change at any moment. It vacillates. So sometimes you feel like you got it nailed, and tomorrow you got to start over again from the beginning.
And as an aside, as I've sat and been able to watch kind of what you've done, it's been interesting because those human effects end up trickling so far through other things in the business. Like as an example, prior to the acquisition, Nexus did things a very particular way. Their systems were configured a particular way to handle internal tickets and deliverables and all of the things that you do. The acquired company had the same. Those two systems were different. And when you sat down to put everything together, it's natural to say, well, we're gonna impose the Nexus way on these things, and we're gonna reorg their teams, show them how to do things different, and we're gonna kind of get everybody unified on the Nexus way. But you get 3-4 months into it, and you start collecting this kind of feedback, and you realize that the acquired company's way didn't work. The Nexus way didn't work. There's actually a better way, and the team has actually been able to organically come up and create better solutions to actually drive better efficiencies. And so I think these are the kinds of things that if you're able to very nimbly identify, diagnose, and then incorporate some of these findings, then that's really what leads to the successful acquisitions and integrations, because nothing's going to go according to plan. Well, a lot of things will go according to plan. You will almost assuredly get at least something that doesn't go according to plan.
Yeah.
So,
if I can add something real quick. I know we're short on time here, but what Garett's describing is actually what you want. That is a 1 + 1 = 3 or more kind of thing. You can't be so married to your process, your system, your way of doing it as the acquirer to blindly believe that you have the right answer. The company you've acquired may have the right answer. You might be acquiring them for that. You may have already identified that, right? Or you may find out in the process that they either have a better answer, or you're combined together, your teams and your leadership together can come up with a better new answer, right? A better new solution. In our case, that's been a lot of what we've been able to do is we've been able to combine that collective brain trust and say, okay, well, let's do an ideation session. Let's mind map this out. Let's figure out, what's going wrong. What was your way? What was our way? Neither way works. Okay, let's come up with a new way and let's try it out. And that's how organizations grow.
Yeah, and thank you for sharing those thoughts. And I think this leads into some of the conversations that we can pull in some of Bill's generations of experience to kind of share with the team. Yeah, generations with an S. No, but see, as a total aside, Bill is a complete stud, and if you need weight loss and fitness tips, this guy is going to do wonders for you beyond just his financial prowess. But ultimately, you run into these issues of gridlock, slowness, challenges implementing and staying on track with an implementation, integration with someone or whatever. And these things eventually boil down to the lagging indicators in your organization, which ultimately are financial indicators and cash flows and investor returns and the whole 9 yards. And the question ends up being, what if you're not able to identify those problems fast enough? What if you do go sideways? What if you find yourself in a difficult position? How do your equity partners view the organization? Will they be willing or able to invest more of their time and energy and capital into it? What about banks and the debt options you have? I wanted to open this up to Bill to kind of talk a little bit more about some of those challenges that can arise and how people can deal with that.
Thank you very much. Again, welcome everybody. Thanks for being here. We appreciate your support and supporting us up here. To me, an M&A activity is kind of like a marriage. And post-deal, it's like the young couple coming back from honeymoon, a great honeymoon, and now staring at a dish full of dirty dishes and saying, now what? We've done this, the excitement of the deal's over, now we're settling into real mundane life. What I have found as a tool right away is you've got two separate companies with two disparate sets of financials, two sets of vendors, two sets of customers, vendor terms, customer terms, two sets of manufacturing processes or services, and ultimately two sets of cash flows. And how do you distill those into one? And do you combine them? Do you take the best of both worlds? Do you take one over the other? And identify very quickly, all right, now, what does our new sales terms look like if you're a B2B and you're not getting a cash on sale? What about the vendor terms? Who are we using? I've got two sets of vendors, fairly similar products. Who do we use? What are their terms? What's the manufacturing? Do we use a 3PL? Do we outsource manufacturing? All these questions, now you're combining two companies into one. Now you have to figure out what the new co looks like and distill those into a set of forecasted financials. Peter, you talked about, was it prospection? You call prospection, I call them a set of forecasted financial statements. It's the same damn thing, all right? Now you got to sit down with both teams, both new companies and the new company, and plot out your forecasted financials, balance sheet, income, and more importantly, cash flow. Because to your point, this new company has to now cash flow for its investors, new owners, and so on and so forth. I mean, you guys have already covered the culture and all the things there. This is where the money rubber meets the road, is can the company now forecast its projected growth and scale? So how do you do that? Well, again, you ascertain your new vendor terms. You're buying a product from somebody. If you're not a service company, right, you don't have to worry about that as much. You're a service company. But if you're a manufacturer or a products company, who are your new vendors? Are you going to maintain the ones you had before or go through a whole new set of ones? You can combine them. What are their terms? All right, what's the duration of manufacturing? Are you bringing them from overseas? What's the payment term? Is it FOB Asia? Is it FOB 50% upon issuance of PO? And then when it hits the U.S. and it goes to your customer, what are their terms? All that's going to consume cash, as you know. And for the new company, you have to take both those, combine them, and know what the outcome is before you have your first day of sales. And if you don't do that, you're toast. I've seen in my career, and I'm more of an angel investor and lender, I've seen more companies dive into just into starvation. They were so successful, they grew themselves into bankruptcy. Why? Because they didn't manage the cash flow on top of that. And with these two combined companies now into one, that's even more important because you have two sets of thoughts and two separate companies how they did it. So I don't know if that answers your question or not, but that is ultimately very, very important to understand the new forecasted financial statements for the new company. Is that what you're after? Or?
I think that all leads into some really important points about, like, so what if a company hasn't managed those things well?
Well, are you talking to your banker or to your investor? Communication. Listen.
Conflict comes up when you have
Yeah.
that unfortunate capital call and say, hey, I need more money.
Yeah.
Running out.
Yeah, I've been in that situation many times. Going through one right now, as a matter of fact. Listen, as far as a capital call, if you have to do a capital call, make it attractive. You know, I was in a situation where a company needed some cash, and they were prepping for a Series A round. And I said, listen, why don't you offer maybe a convertible note or even a safe agreement or something? These people are going to invest anyways. They're prepping to invest in your A round. Why not give them the opportunity to get a discount? Get your money today, give them a discount. Yeah, you had an issue. Here's how we're going to circumvent it. But this issue is an opportunity for you to get in the next round at a discount. So whether it's a safe, whether it's a a convertible note, whatever it is, use that to your advantage and give their buy-in. Number two, again, is just communicating it, before it happens, before it hits the financials. Say, listen, I see something on the horizon. Oh, and by the way, here's a new set of forecasted financial statements. See how in month 5 I see us running out of cash? We need to put our heads together and work as a team to close this gap. Whether it's a capital call, whether it's going to a larger bank, whatever it is, engage your investors early so that they're part of your solution. You're not us versus them. You're in the same boat, and you either sink or swim together. So engage them early. But again, I like to illustrate through forecasted financials and pinpoint this is why we're going to run out of cash. This is where what happened, where the wheels fell off. Here's how we put them back on and get going. And if you can demonstrate that, not just the issue, but I predict in month 7, here's how we work out of it, you're going to have better cooperation. And with your bank, it's the same thing. If you're having issues with your banker, tell them right away. Walk in their office, sit down and say, yeah, I don't owe you financials yet, but here's what's happening. All right? Here is what I see happening in 3 months from now. Can we work together on this? If they find out on themselves, they're going to be pissed. If you tell them in advance, and they can start prepping and working with you, they're going to be a lot more accommodating to work with you. That's what I've seen in my career many times over.
Yeah, I think just reiterating, and thank you for sharing that wisdom. I think probably the best thing you can do is having, I see a lot of companies personally that fail to adequately engage their capital partners, whether that's the bank or the investors early. And at the end of the day, especially when it comes to your equity partners, they're already vested in your company. They've put that there. They like you. They're there for the long haul. They're willing to make sacrifices. They already put money in your crazy idea. And when stuff really hits the fan, these same people would be willing to double down on that in a lot of cases and really be a part of that solution and bail out, unless you tell them the night before.